For years, millions of UK pensioners have relied on the state pension as a steady source of income in retirement. But now, the very lifeline that was meant to support a comfortable old age is being pushed dangerously close to the taxation line, and in many cases, it's already crossed it. The Department for Work and Pensions has now broken its silence on the growing calls to raise the income tax allowance for pensioners. And make no mistake, this update could have serious implications for your monthly income. As it stands, the full new state pension has increased to nearly £11,973 a year following the April 2025 uprating of 8.5%. However, the personal income tax allowance, the amount you can earn tax-free, remains frozen at £12,570 until at least 2028. That might seem like a minor difference now, but by 2027, projections show that pensioners receiving the full new state pension will be earning more than the tax-free threshold. That means even if you only have your state pension and nothing else, no private pension, no savings interest, no rental income, you could still be liable for tax. And that's before we even talk about the millions who rely on additional income streams to make ends meet. What the DWP is now admitting is what many pensioners have been feeling for years: the system isn't keeping pace. The government's refusal to lift the personal tax allowance, even as inflation and living costs continue to rise, effectively results in a stealth tax on the elderly. It's not an overt tax increase, but one that creeps in quietly, shrinking your real income year after year. Pensioners, particularly those on fixed incomes, are bearing the brunt of this fiscal stagnation. So what is the DWP planning? Will the tax allowance be raised to reflect the rising state pension and give some breathing space to older citizens? Or are we headed for even more pensioners being pulled into the tax net, paying 20% on money that was supposed to support them through their later years? Stick with us, we've dug into the latest DWP statements and expert insights to bring you clear, up-to-date answers about what's really changing and what it means for your wallet. Don't forget to like, subscribe, and leave your thoughts in the comments. We're here to keep you informed. Let's break it down clearly and calmly, because this issue affects nearly every pensioner across the UK, and the consequences are only going to grow more serious if the current policy holds firm. When we talk about the personal tax allowance staying frozen at £12,570 until 2028, many people hear that and think, oh, that's just a number. But here's where it starts to pinch. Back in the day, that tax-free allowance used to provide a comfortable cushion. You could take in your state pension and maybe even a small private pension or savings on the side and still stay beneath the limit. But now, with the full new state pension rising each year due to the triple lock, that so-called cushion is getting thinner, and soon, there will be no cushion left at all. What's happening here is what many experts are calling fiscal drag. That's a fancy economic term, but what it means is quite simple. The state gives you a pay rise, and then quietly claws a chunk of it back through taxation. And that's exactly what's happening with pensions. The triple lock ensures your pension goes up by whichever is highest earnings, inflation, or 2.5%. Sounds generous, right? But when the personal tax allowance doesn't rise to meet it, all they're doing is handing you a slightly bigger cake and then charging you to eat a slice of it. Now, let's not forget who's impacted the most by this. It's not the wealthy elite or the high-earning professionals. It's the everyday pensioners who spent decades paying into the system: nurses, factory workers, teachers, tradespeople, folks who worked hard and paid their fair share of tax while they were working, only to find they are still being taxed after they've retired. And it's not a case of being flush with cash. These are people trying to stretch a modest pension over a week's worth of bills, food, heating, and unexpected expenses. Every pound counts. Every deduction stings. So when the DWP makes an announcement, even a small one, about reviewing or responding to growing pressure to raise the personal tax allowance, people listen. And rightly so. Because it's not just about figures on paper, it's about people's lives. It's about whether someone can afford to turn the heating on in January, or buy a fresh bag of groceries without watching their bank balance slide into the red. That's the real-life cost of freezing the allowance while letting pensions rise. Now, to be clear, this isn't some hypothetical situation that might happen in a few years. It's already happening. This April's pension increase puts the new full state pension at nearly £11,973 a year. That leaves just £597 before someone hits the taxable threshold. Add in a tiny bit of interest on your savings, a part-time job to top things up, or a small private pension from a former employer, and boom, you're paying 20% on the difference. Some retirees are even being told they owe tax despite never having received anything close to a luxury-level income. And sadly, many don't realize until they get the dreaded HMRC letter in the post. There's also a broader issue of fairness here. When people planned for retirement in the past, they did so assuming that their pensions would be mostly untaxed, or at least that they'd have room to breathe. But because the government has chosen not to raise the allowance alongside inflation or pension increases, what we're seeing is a broken expectation. Pensioners are being hit with surprise tax bills that weren't part of the deal when they retired. And let's face it, for someone living on a fixed income, it's not easy to absorb those costs. The DWP is now under growing pressure from MPs, from advocacy groups, and from everyday citizens to do something about it. The conversation isn't just about numbers anymore. It's about trust. It's about whether the system is keeping its promises. Many campaigners are calling for a specific tax allowance just for pensioners, similar to what existed in the past, where the allowance would be adjusted separately from the general public to ensure it keeps pace with the rising cost of living and pension increases. Of course, the government argues that freezing the allowance helps them bring in more revenue without raising the tax rate itself. But let's be honest here. If that revenue is coming from the pockets of pensioners, is it really justifiable? Is it really the best way to balance the books? Especially when the country has a growing elderly population who are more likely to need NHS care, housing support, and other public services that become harder to access when their budgets are being chipped away from both ends. Another concern that's been raised is the lack of clarity many pensioners face when it comes to understanding their tax obligations. Some are unaware that they could be entering the tax bracket at all. Others may be caught off guard by HMRC claiming back taxes for previous years. And while there are services available to help with understanding your tax situation, they can often be difficult to navigate, especially if you're not particularly tech-savvy or if you struggle with formal financial language. It's easy to feel overwhelmed, even if you've always been careful with your money. So what can pensioners actually do about it now? One option is to look carefully at all sources of income and try to manage them in a way that keeps you just under the threshold, though this is often easier said than done. Some financial advisors suggest drawing down less from private pensions in a single tax year or spreading withdrawals over multiple years. Others recommend deferring your state pension if you haven't started claiming it yet, which could increase your eventual payments and help you delay entering the taxable zone. But these strategies aren't suitable for everyone, and not all pensioners have the luxury of financial maneuverability. There's also the option of placing savings in ISAs, which offer tax-free returns. Again, though, this depends on having savings in the first place. For many pensioners, the state pension is their only or primary source of income, which leaves very little wiggle room for investment strategies. That's why so many are calling for a structural change and official policy update that either lifts the general personal allowance or introduces a separate, higher allowance specifically for those over state pension age. It's worth noting that this isn't a radical or new idea. The UK used to have an age-related personal allowance that recognised the fact that older citizens generally have lower incomes and higher living costs. But this was scrapped in 2016 under the justification of simplifying the tax system. Whether it simplified anything is debatable, but it certainly made life more difficult for pensioners. Bringing back a tailored allowance wouldn't be revolutionary, it would simply be a return to a more balanced, thoughtful approach. In recent months, members of Parliament from various parties have raised this issue in the Commons, urging the Treasury to reconsider the freeze. Even some Conservative backbenchers have expressed concern, especially as more constituents begin to feel the impact. The debate is now more public than ever, and with a general election looming in the near future, it's likely we'll hear even more promises, proposals, and hopefully firm policy changes related to pensioner taxation. But while politicians debate in Westminster, pensioners continue to feel the pressure today. The worry isn't theoretical, it's real and it's present. The energy bills don't wait for Parliament to vote. The council tax notices don't pause because of a fiscal review. These are immediate concerns, and many pensioners are looking for answers right now, not 5 years down the line. The real question is this: should pensioners be taxed on the income they receive from the very system they paid into for decades? Should the state pension meant as a foundational, not luxurious, retirement support really be subject to tax at all? Or should it be protected as a basic right of citizenship, like the NHS or access to education? The answer to that question will vary depending on who you ask. But for many UK citizens, especially those over state pension age, the answer is clear. They see the current situation as unfair and unsustainable. And unless the government acts soon, it's likely that discontent will grow. For now, it's more important than ever to stay informed. Check your tax code, review your income sources, and don't hesitate to contact HMRC if you believe there's been a mistake or if you're unsure about your liability. You can also speak to organizations like Age UK or Citizens Advice, who offer support and guidance tailored to your needs. But more than anything, keep the pressure on. Speak to your local MP, join campaigns. Sign petitions. Because when people speak up, especially when they do so together, policymakers take notice. The DWP may not have raised the allowance yet, but the conversation has begun. And with enough momentum, it could become more than just talk. It could lead to real, lasting change for every pensioner across the UK.